Can you define parabanking? Parabanking includes all the services provided by banks apart from day-to-day banking. For example, debit cards, credit cards, life insurance products, cash management services, etc. What is Marginal Standing Facility, MSF? In MSF, banks borrow money from RBI for up to 24 hours. MSF is always 1% above the repo rate and banks can draw only up to 25 of their NDTL from RBI. Can you define white label ATM? White label ATM refers to ATMs owned by corporate or private operators seeking to earn a commission by banks for transactions performed by their customers. For Indicash by Tata Group. Can you define brown label ATM? Brown label ATM refers to the ATMs where investment, installation and maintenance is by a private operator but the license and branding is by a commercial bank. What is the difference between FI and FDI? FDI or foreign direct investment is an investment that a parent company makes in a foreign country. For foreign institutional investor is an investment made by an investor in the markets of a foreign nation. FI can enter the stock market easily and also withdraw from it easily. But FDI cannot enter and exit that easily as FDI only targets a specific sector. What is capital adequacy ratio? What is demat account? CAR is the proportion of capital to the bank's risk. Demat accounts are those in which shares, securities and insurance policies are kept in electronic form. What is the CAD? What is fiscal deficit? CAD or current account deficit is the difference between the imports and exports of a nation in one financial year, whereas fiscal deficit is the difference between total revenue and expenditure of a nation. Can you define charge-off? It is a declaration by a lender to a borrower for non-payment of the remaining amount, when borrower badly falls into debt. The unpaid amount is settled as a bad debt. What LIBOR stands for? LIBOR stands for London Interbank Offered Rate. As the name suggests, it is an average interest rate offered for US dollar or euro dollar deposited between groups of London banks. It is an international interest rate that follows world economic condition and used as a base rate by banks to set interest rate. LIBOR comes in 8 maturities from over 9 to 12 months and in 5 different currencies. Once in a day LIBOR announces its interest rate. Can you define payday loan? A payday loan is generally a small amount and a short-term loan available at high interest rate. A borrower normally writes post-dated checks to the lender in respect to the amount they wish to borrow. Can you define Cost of Funds Index, COFI? COFI is an index that is used to determine interest rates or changes in the interest rates for certain types of loans. Can you define Convertibility Clause? For certain loan, there is a provision for the borrower to change the interest rate from fixed to variable and vice versa is referred as convertibility clause. Can you explain check endorsing? It ensures that the check get deposited into your account only. It minimizes the risk of theft. Normally, in endorsing check, the cashier will ask you to sign at the back of the check. The signature should match the payee. The image over here shows the endorsed check. Can define HTM and AFS? Available for sale, AFS, held to maturity, HTM. Can you explain mark-to-market? Mark-to-market is an accounting practice by which companies value and report their assets, especially financial instruments, at market price. Market price basically refers to the price at which the asset, or a similar asset, is trading at in a public exchange. The concept is derived from the accounting principle of prudence. Can you explain dated securities? Dated government securities are long-term securities and carry a fixed or floating coupon, interest rate, which is paid on the face value, payable at fixed time periods, usually half-yearly. The tenor of dated securities can be up to 30 years. What is Cost of Funds Index, COFI? COFI is an index that is used to determine interest rates or changes in the interest rates for certain types of loans. Can you explain Treasury bills? Treasury bills are the instruments of short-term borrowing by the central, state government. They are promissory notes issued at discount and for a fixed period. These were first issued in India in 1917. Treasury bills, T-bills offer short-term investment opportunities, generally up to 1 year. They are thus useful in managing short-term liquidity. At present, the Government of India issues 3 types of treasury bills through auctions, namely, 91-day, 182-day and 364-day. There are no treasury bills issued by state governments. Can you define yield? In finance, the term yield describes the amount in cash that returns to the owners of a security. Normally it does not include the price variations, at the difference of the total return. Yield applies to various stated rates of return on stocks, common and preferred, and convertible, fixed income instruments, bonds, notes, bills, strips, zero coupon, and some other investment-type insurance products, for example annuities. Can you explain convertibility clause? For certain loan, there is a provision for the borrower to change the interest rate from fixed to variable and vice versa is referred as convertibility clause. What is the difference between microfinance and microcredit? Microcredit is giving a small amount of loan to the customers whereas microfinance is a wide term. It includes small loan plus training on financial matters. In other words, microfinance equals microcredit plus financial literacy. Can you explain financial inclusion? Financial inclusion is the availability of banking services at affordable cost in order to include the weaker section of the society in the banking system. In 2004, Kofi Annan, UNO head, was addressing UNESCO conference and the word financial inclusion was for the first time used by him at that time. In 2006, a committee was made under the chairmanship of Mr. H.R. Khan for financial inclusion and the report said that 57% of Indian population was deprived of banking facilities. What are the different types of fixed deposits? There are 2 different types of fixed deposits. Special term deposits. In this type of fixed deposits, the earned interest on the deposit is added to the principal amount and compounded quarterly. This amount is accumulated and repaid with the principal amount on maturity of the deposit. Ordinary term deposits. In this type of fixed deposits, the earned credit is credited to the investor's account, once in a quarter. In some cases, interest may be credited on a monthly basis. The earned interest on fixed deposits is non-taxable. You can also take a loan against your fixed deposit. Can you define term repo? Under term repo, RBI lends to banks through auction of funds. The minimum interest charged has to be above the repo rate and there is no limit for maximum interest rate because auction is made on the rate of interest. Can you define LAF? Liquidity Adjustment Facility, LAF, was introduced by RBI during June 2000 in phases, to ensure smooth transition and keeping pace with technological upgradation. Can you explain CRR rate? Cash Reserve Ratio, CRR, is the amount of funds that the banks have to keep with RBI. If RBI decides to increase the percent of this, the available amount with the banks comes down. RBI is using this method, increase of CRR rate, to drain out the excessive money from the banks. Can you explain SLR rate? SLR, Statutory Liquidity Ratio, is the amount a commercial bank needs to maintain in the form of cash, or gold or government-approved securities, bonds, before providing credit to its customers. SLR rate is determined and maintained by the RBI, Reserve Bank of India, in order to control the expansion of bank credit. SLR is determined as the percentage of total demand and percentage of time liabilities. Time liabilities are the liabilities a commercial bank liable to pay to the customers on their anytime demand. SLR is used to control inflation and propel growth. Through SLR rate tuning, the money supply in the system can be controlled efficiently. Which are the oldest banks in India? In 1839, some Indian merchants in Calcutta established India's first bank known as Union Bank, but it could not survive for long and failed in 1848 due to economic crisis of 1848-49. Similarly, in 1863, Bank of Upper India was formed but it failed in 1913. In 1865, Allahabad Bank was established as a joint stock bank. This bank has survived till date and is now considered as the oldest surviving bank in India. Subscribe to our channel, Interview Gig. Visit our website for more articles and interview questions and answers. www.interviewgig.com. Like, share and comment. Don't forget to click the subscribe button. Click the bell button for latest updates.